Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com.
So greetings and welcome, Álvaro. It's fantastic to have you on the podcast. I've been looking forward to our conversation for a while now.
Yeah, well, thank you very much for having me. I've also been looking forward to this. So hopefully we'll entertain you and the audience.
Great. Now, before we go into the heart of our conversation, I do like to ask something of the origin story of my guests. So tell me a bit more about yourself. Maybe we can start with what you studied at university, and was it inevitable you'd end up in finance, academia, and this whole world?
Right. So I grew up in Venezuela a long time ago, and I did my undergraduate in economics in Venezuela. And one thing I didn't realize back then was that you had to know a lot of mathematics to actually understand the theory and the papers people were writing. So I had this sort of naive idea that if I did a lot of mathematics, I would become a very good economist. So then I moved on to the UK and did an undergraduate in mathematics. And I chose pure mathematics, don't ask me why, thinking that all of that will enable me to then do better econ or theory in econ. And at some point I entertained the idea of just becoming a mathematician or carrying on doing econ finance. And I went to Chicago for a couple of years where I did mathematical finance and econ, both at the University of Chicago. And at that point, I did decide that I'd rather do finance. And the reason was peculiar and mostly mathematical finance. I just thought that I could not really do macroeconomics is something so important that would touch too many people's lives, and I didn't want to feel responsible. So naively, again, I thought that doing finance, you wouldn't touch people's lives. And there we were in 2008 with this massive crisis. And I was kind of ashamed of saying that I was a financial mathematician, because after Chicago, I returned to the UK and I went on to do my PhD in mathematics, but I specialized on mathematical finance, doing things that I thought had no subjective component to it, to avoid imploding people's lives and so on, just to, as I said, figure out later on that in fact we were touching many people's lives with the things we were doing at the time that we still do, right? And I think that was an important lesson I learned the hard way, but here we are.
Absolutely, yeah. And just out of interest, you've been at a number of these big prestigious universities, say Chicago versus Oxford. Are there kind of any obvious cultural differences between the two, you would say?
Well, there are massive differences. I think Chicago still is the way it was when I was there in the late 90s. It's an environment where competition is everywhere. The students are super bright, and so are they, here in Oxford. But Chicago has this culture of working 7 days a week, 20 hours a day. And it's wonderful, right? I learned a lot, but that culture can make or can break people. Also is a culture that those who are really good then end up doing extremely well. And those who are not as good, which is normally the case, I was never the top of my class, then you feel the pressure. Oxford is, again, the same. I would say the quality of the people is the same, but it's a little bit more relaxed, and people are allowed to stray away in other topics that are not the core of their research. So you can entertain yourself having coffee, talking about something completely different from your research topic. And that is acceptable. And overall, I think it's okay. But, it just produces two different sets of people that compete in a different way. And, the outcome is great. Both places produce great academics and great professionals. But Chicago was too cold, I have to say.
I can imagine. Now, one of the big themes and topics that has really exploded onto the scene over the past year and a half has been artificial intelligence. Now, of course, artificial intelligence in its various forms has been around for a long, long time, for decades, going back to the 50s, you could say. So perhaps what we can start with is defining what we mean by artificial intelligence, because people use it to mean all sorts of different things. So, I'm going to put you on the spot here and ask you to define what we mean by AI.
Well, so before I give it back, my definition, which is not really my definition. So, as you know, currently I'm the director of the Oxford Man Institute. So we're an institute that's sort of sits in the middle of Oxford, underpinned by the Mathematical Institute, by the Stats Department, by the Said Business School, by the Engineering Department, Computer Science, and all of our students belong to one of these departments working on pretty much data science and finance. So I'm surrounded by a lot of energy and a lot of people working at the interface of machine learning, AI, NLP, and all of the things that one hears everywhere. And I do ask them, what is machine learning? What is artificial intelligence? And it's very difficult to find a consensus. So to me, AI is an elusive concept that is perhaps evolving. And I just want to stick to a very vague notion of what I would think AI is that, you have a machine or something that you would like to mimic somehow the intelligence of a human being, and one of the key points there, that they can learn. Okay, so machines learn, that they may have common sense, that they can reason. And those are very sort of difficult aspects that perhaps later on throughout the interview we'll come back to, especially the common sense or morality of what you do. So if you want to mimic what humans do, that's what the machines should be attempting to do. Now, everybody has their own definition. So normally I kind of ask people, what do you ask me? What do you mean by this? So I end up seeing things as black boxes that are instructed to do certain things.
Okay.
I'm sure we'll come back later to this.
Yeah, I think we're going to unpack this a bit as we go along. But I know one of the areas you've done a lot of work in is trading and trading algorithms and so on. So perhaps we can use that as a vehicle to kind of talk through this whole sort of topic of how AI will impact markets and financial markets and so on. So from the evolution of trading, I mean, from a sort of, if we caricature it in a very stylized way, I mean, how would you sort of describe the evolution of trading?
Okay, so again, we see it in films, the open outcry, people sort of signaling and buying, selling in the 70s, 80s, and, perhaps early 90s. So a lot of the trading floors were populated by people. So gradually we moved on to machines, and I think electronic trading became something quite important. And you had, NASDAQ was there, I think, since the 70s, but only, I think, in the 90s with the computer power, well, the advent of the internet and computer power sort of put electronic trading up there as the way to sort of buy and sell. So after all, computers provide a market. And of course, electronic trading allows access to that market from many, many places, not only a trading floor, in a much faster than what we were used to. So the 90s saw a growth of electronic trading. And then, of course, you can imagine that those traders who were very clever and had all of these ways in which they could sort of perceive what the market was doing, demand pressure or supply pressure, started coding up some of these strategies in a very simple way onto a computer. And then the computers would take the decisions when to act or not according to this hard code that was in the box. Then I think if you fast forward a bit, 2010 to me is a crucial year where everybody realized that algorithmic trading was something important. So in May, I think it was, May 2010, we had this massive flash crash. The markets dropped. So we've seen sort of crashes of the market that would just take years, the 29 crash in the 80s and so on. But now in May 2010, we have this, what we call the flash crash, that markets dropped by a lot and just only to recover 30 minutes later. So the Dow Jones, the S&P and so on just took a massive hit. And then it was all over the news. You could read it every day in the Financial Times. And they were trying to blame that this interview is not about the flash crash, but we were trying to find a reason why this could happen. Why did it happen? Why was the recovery so quick? So the sort of focus turned onto algorithmic trading, which is basically coding up trading strategies, the usual way, but you do it faster. And perhaps you have
these trading strategies, they're static in the sense that, someone comes up with a rule to say, okay, there's more order pressure here, you move the bid or the ask. It's like that. There's no learning per se.
Exactly. So if you think the way I look at this, so I've spent most of my career on the mathematics of algorithmic trading. So what I've done with my co-authors for the last 15 years is precisely look at mathematical models of how to optimally trade. And they're quite, well, they're dynamic in the sense that they are maximizing profits and looking at the future, how you do things best, but they're hard-coded and the rules are there, how to act under different scenarios. Now, more computer power comes into the game and more data. So initially, internet and computer power allowed us to sort of code the trading strategies. Now we have access to a lot more data, to sort of the usual data sets, but also alternative data sets. We have access to more sort of compute power, and all of that sort of, if you want to remain competitive in the market, then you say, okay, these algorithms, we can make them a bit smarter. We can allow them to also learn as they go along. Because after all, when you're trading, these are anonymous markets. So most of my examples will be, I'm thinking of an equity market like NASDAQ, where trading is anonymous. People are buying and selling. You don't know your counterparts. You just know that there's an order sitting there. You can trade against it and so on. But at some point, you realize that adapting to what's going on, adapting to how the environment is reacting to your own trading activity and other people's trading activity, or people, or the machine's trading activity, how do you self-learn, or how do these algos adapt to the new circumstances, is what has become what we probably want to say AI and trading. Okay, because these
and when you
boxes
say
now.
alternative data, just to be clear, are we talking about existing data, but more higher frequency? So, tick by tick, or are you talking about just data sets we haven't looked at before?
Well, data sets we have not used in the algorithms to trade. So let me give you a very simple example, an extreme one. So NLP, natural language processing. So you may be using a computer to read every day the news and process what's going on, to read what CEOs of companies are saying, to try and sort of tease out exactly what they meant, and then plug in those signals also into your trading algorithm. So alternative means in this particular case that, perhaps they were around, but you just didn't have the capacity to process them quickly enough to integrate them with other trading, more basic stuff. So normally, if you look at the algorithmic trading strategies in the early 2000s, all of them are looking at the bid, the ask, the depth in the book, the liquidity, perhaps looking at more than one electronic book at any one time to see co-movements between assets. So that's where you would stop, because you didn't have the capacity to expand and include more. Now you can. So, a tweet that comes out perhaps now is as important as a market order that wipes through an entire book, right? So including all of those alternative data sets, has an impact on how the market moves and reacts and how prices are formed, okay, which is quite an important thing.
And in terms of the machine learning type models that started to get employed, are these things like decision tree models, like random forest, gradient boost models, neural networks? Is it what I guess now we call, I don't know, classical machine learning?
Exactly. Well, yeah, they're all those, right? So funnily enough, I've been writing all of these papers for 15 years, let's say, and I know many of them are being used in the industry or a form of them. I've never worked for a bank, so I couldn't say exactly, but for sure, what you just mentioned is what people are using, and anything that gives you a competitive advantage, you will try and implement. So it wouldn't surprise me that everything you see in a textbook is being implemented. Now, there is a big discrepancy between what theory is doing and what gets implemented, because there's always this problem about speed. And in markets, being fast is not enough. You have to be faster than the second fastest guy, right? So this relative speed problem, forces you also to write algorithms that can quickly learn what's going on and can quickly react to market circumstances. Because normally, if there's an arbitrage opportunity or there's a statistical arbitrage opportunity, these don't last for very long. And they get, sort of snapped up by one box, one black box, and that's the end of it. So there's a compromise between speed and how careful you can be about applying a complicated neural network to make a decision to buy or to sell.
Yeah, understood. Yeah, so you talked about this explosion from 2010 onwards, suddenly alternative data, more use of sort of machine learning. And then how did that affect, the electronic trading?
We are still trying to figure out the effect, in the same way that we took many years to see whether high frequency trading was good or bad. And I don't think you can ever say that something is black or white. At the moment, what we're trying to understand is the effect of all of these black boxes that are self-learning how to act on the market. What is going to happen in the medium to long term? Are these black boxes beneficial for the integrity of the market? Are these black boxes going to help us improve market conditions? And that's where a lot of the studies are going on, at least the ones we are conducting at the Oxford Mann Institute, are to understand mostly the unintended consequences of AI and trading. We want to focus on something that will be good for society. It is clear that you expect a lot of good things to come out of AI and trading. So let me give you an example. One thing we care a lot about, as either as society stakeholder, as an investor, as an owner of a hedge fund, we just want prices to be informative. What do we mean by that? That when you buy or you sell at a price that you see in the market, that price really reflects all available information that can be impounded into that price. You don't want to be buying at the wrong price. You don't want to be selling at the wrong price. So you hope that more sophisticated algorithms, those that take into account more data sets and have a better picture, let's say, of what's going on in terms of the value of firms, will deliver prices to the market that are very efficient, meaning that they're informed as much as you can be. So that's one expectation of AI and trading, that markets will become more efficient. That another expectation could well be that it's reduces the cost of trading. We have seen that, for example, spreads over the years have shrunk. They are remaining stable. There's many ways in which you can measure whether the market is healthy or not just the difference between the bid and the ask. There's many ways in which you can look at it, whether the markets are deep, whether they can take a big order without a huge market impact. And again, your hope is that AI and algorithmic trading will deliver some of these improvements, but we're still, in the process of figuring out, where, if it's working. At the moment, there's nothing to indicate that it's not working. Okay, so everything, it's very difficult to look at the data and say, well, something here is not working. We're ticking along in a normal way because we're still, people are finding their bearings, and people are still, sort of expanding, buying more compute power. So let's see over the next 5 years how things map out.
And before we talk about some of the more negative unintended consequences of black boxes, I did want to ask, because I've worked in banks, all my life until MacroHive, and one thing that's quite evident is that you can use the models for the very liquid markets, in FX, cash equities, and so on. But then, derivatives, second generation derivatives, it's harder to use these models, because there's less data and it's lower frequency. But is there something here about that they work that limits it from being used on lower frequency or less less deep markets or not? I mean, is that what you kind of? I mean, theoretically,
I don't think there's any limitations. I don't think that's an interesting question. The question is that there's no limits, right? Maybe you would expect that illiquidity, is not as bad anymore because you're more informed about what things. But there's no limits to the use of this. You can see it as algorithmic trading on steroids, really, with more data and more compute power. So there's no reason why it would work better or worse, right? The one interesting thing, if you want to start focusing on some of the unintended consequences, is whether those markets that are less liquid, that are they have fewer players and so on, whether those who come with new technology and disruptive technology are going to benefit too much in a way that it doesn't look as a competitive market. Well, we can return to that point later on, but the consequences might be exacerbated. The intended and the unintended might be exacerbated a little bit by these people who can, act in these markets in a completely different way from the way we used to see it 10 years ago or 5 years ago.
Okay, no, understood. Okay, yeah, that makes sense. So in terms of the more sort of negative side, I mean, from your perspective, kind of theoretically, I mean, what are the obvious ways where there could be some sort of negative unintended consequences of a market dominated by black boxes?
Okay, so again, I want to, that's I wouldn't say a loaded question, but it's a difficult question because it just focuses on the negative stuff. And, the research I've done throughout my entire career focuses a lot on my math and the strategies and so on. Lately, we have focused precisely on some of the unintended consequences, because somehow I feel it would be nice to help regulators and society understand some of the unintended negative consequences. So I will describe a little bit the studies we have done at the Ottoman Institute with my colleagues and students. And, we pretty much find four things, right? They're all interconnected. So one question is, are these black boxes going to learn to communicate with each other? That's kind of an interesting question. But, as I said, these markets are anonymous. They only meet at the exchange or the matching engine of the exchange. So you say, well, how can they communicate? But, indeed, one of the things that we show is that these learning algorithms will learn to coordinate actions and take the market to equilibria or non-equilibria, but will take the outcomes you will see are not competitive outcomes. What do I mean by that? So normally a basic tenet is competition is good because it will drive prices down to the competitive level and will send the right signal for investment and so on and so on. And I believe a lot of that stuff. Now, if you have black boxes trading, where somehow they are using learning strategies that, iterating over and over and over again, they coordinate each other into converging to prices and outcomes that are far away from the competitive outcome, then you have to worry about that. So imagine if the price is the true price should be 5, and it's difficult, it's very difficult to say this is the right competitive price. So let's say theoretically you say the price of something is 5, but people like OPEC, right? They coordinate and they push the price up only because they are, the strategies are tacitly colluding into or coordinating into an outcome which is far away from the competitive one. And that's kind of a big worry for society. It's even a big worry for the firms using the algorithms. No one there sets out to write an algo. I'll come back to that sometimes that could be intentional, but no one tries to write an algorithm that will rig the market. But if many black boxes or a few black boxes are really in charge of the market, they might coordinate into prices which are not great. So that's one thing we find. Another thing we find
that's sounds almost sci-fi like, the robots start to coordinate against the humans. But in some ways, they're behaving more like humans, I suppose.
Well, they're behaving like humans who can pick up the phone and say, oh, come on, don't undercut me. Let's just keep the prices up here. And that never happens. The machines don't talk to each other, but the way in which they test the market and sort of provide prices, or they buy and sell, can be picked up by another algo to say, well, if I change my strategy, we can coordinate each other and reach an equilibrium price, which is well above the competitive price. So there's a big difference that I want to make here, because it's important for the community. It's a theoretical thing, but actually it's good for the regulators to know and so on, is that coordinating actions into an equilibrium does not mean collusion automatically, right? So one of the things we show, so for example, let's think of an electronic order books. There's bids and asks, and you can post the orders on a grid of prices. These algos can, without really colluding, and I'll give a precise definition of colluding, can coordinate an action and agree that the best ask should be 10 and the best bid should be 5. Okay, and they quote a really wide spread there, and they just don't find a reason why to deviate from that. So for those who know game theory, you can say, well, that's the Nash equilibrium. The Nash equilibrium could be that knowing that you posted 10 at the bid and 5 at the 10 at the ask and 5 at the bid, I do the same. We have no incentives to deviate from that strategy. That is a Nash equilibrium. Okay, so it is very difficult to argue that they are misbehaving. They just find a strategy that, you don't want to deviate after you see the outcome. Now, a collusive strategy is one, again, where, you end up coordinating or end up at a point that is sustained by punishment. Okay, so collusion actually requires a reward punishment mechanism that if you deviate, will punish you. So you and I start agreeing, let's put the bid at 10, 10, 10. And all of a sudden, well, if I undercut this guy, or the machine says, if I undercut, I will sort of make money in the short term, but I will punish you. My black box will punish you. So some of the studies we do, which are quite theoretical, pretty much provide all of the theory to say that learning algorithms will learn to collude. And it's kind of as you say, it's a sci-fi thing. They start playing, and the learning is as they play. And that is the interesting thing, because these algos don't know exactly the environment, don't know exactly who the competitors are, don't know exactly what's going on. And they're very simple. They have simple rules, how to do things. And then they end up coordinating into actions that it is clear that they are sustained by punishment. And that is kind of the definition of collusion, that lawyers will use and regulators will use. So one has to distinguish between outcomes which are Nash equilibria, okay? So you and I would not want to deviate, and not the competitive outcome, which is not great and great for society, but they're not sustained by a reward punishment mechanism, which would then take it to a collusive one. But something that we haven't discussed, which I think is important, is, people might be saying, well, what is AI and what are these things, right? So how are these black boxes, how do they work? So to me, one of these self-learning algos is a box where you give it a very clear objective. So let's maximize profits. Then you also give this box a very clear set of actions and states. So the black box knows that there are some actions that can take, post the bid at 5, at 4, at 3, at 2, or post an ask at 10, 11. You give the actions to them, and then this is where the important stuff comes. Then the box has a rule to decide which action to take. So the box at any point in time looks at the data and says, okay, my rule is to do buy, sell, or post here or post there. Second to that, there's a rule to update the rule. And this is very important, because the rule to update the rule is a rule that says, given what you have seen in the past, given the performance of the different actions you could have taken under the different states of the world, I'm going to update the rule. I'm going to tweak it. So this rule to update the rule is where a lot of the tweaking and responses to the environment kick in, which is quite different from the algos you and I initially discussed like 10 minutes ago, which is you give the black box a fixed set of rules and you do it and repeat them over and over again. These self-learning algos will be updating the rules according to past performance and new data that's coming in. And of course, the environment and how you affect the environment feeds into this rule. That's where you can start seeing why some of these algorithms that they end up coordinating, because they feel the actions of the opponents, and they get fed into the decision how to update a rule, which then change my behavior according to what I'm seeing. So all of that combined will take you to perhaps, will coordinate you into equilibria we don't like. The most important aspect of this black box is you do not endow them with a moral compass. You see, some people think that the black boxes know right from wrong. The black boxes don't know right, don't know wrong. They just have an objective, which is to maximize profits or to minimize costs, and they don't care about the rest. Within this fixed set of parameters and rules and actions, they'll try and give you the best result.
And the learning comes through having sets of rules to enact actions and ability to change those rules, which is the learning kind of mechanism.
Exactly.
There's no morality to say that be nefarious or something, or be morally good, or there's nothing like that. It's just
nothing like that, or we seem to be coordinating with the other guy instead of competing. You don't have that coded into the box. So which sets a completely different question from the law point of view. So who is responsible for the bad outcomes? But that's a different thing. I don't know if we'll have time to discuss it, but that is a very important thing, that the environment changes, you pick up the changes in the environment. Some of them you cause yourself, Some of them were caused by the other people's actions. And then you sort of tweak the strategy and try again and try again. And you can see that sometimes I'll coordinate you to an outcome which is not competitive. Let me tell you something again, which is, worrying. Imagine after all of I've told you here, these black boxes are very clever in the sense that will learn things that you expect them to learn, and will perhaps, and that's a hope, will learn things that you didn't know that were there. And that could be quite good for markets. They can discover patterns out there. They could discover exposure to risks in other asset classes that you were not seeing before. And then, all of that should help the market. But they can also pick up on things like this. The black boxes will know that there's certain signals out there that people use to trade. So somehow, a simple one is demand and supply pressures in the market. You can look at the electronic order books and you can see whether there's a lot of pressure to buy or a lot of pressure to sell a particular asset. And normally that indicates or triggers actions into other people's, sort of appetite to buy or to sell the asset. Once the black box realizes that there are signals, or that when volatility is high, the market behaves in a different way from when volatility is slow, the black box will try, if the actions allow it, will try and rig the signal to its advantage. So one of the papers we have at the Oxford Institute is precisely showing that we write a model that shows when the black box understands that demand and supply pressure is an indicator of how other people react to the market, the black box, rather than reacting to the signal itself, will rig the signal, entice all the market participants into some sort of behavior, and then act to the black box's advantage. And that is quite worrying. So
absolutely, yeah. So understands the signals other people are using, and then does a series of actions that changes those signals to then lead to another action. So that's market manipulation, I suppose.
Exactly. So you can classify that one as market manipulation. Why is it wrong? It's wrong on many levels. So at a very high level, it's wrong because price discovery or price efficiency is impaired. We start to say, these markets, it's nice to know that you're buying at the right price or selling at the right price because someone else there is doing the homework. Myself, whenever I buy or sell, I just hope that the price I see on the screen is the right price. And I'm hoping that people out there are doing their homework and are pushing prices to where they should be, aligning the price with the price of the share with the fundamental value of the firm I'm trying to buy. But now, the moment you start rigging signals, this sort of price efficiency will be challenged because there'll be less information out there to know exactly where this price is. Okay? The boxes will keep on making money, but you can have temporary deviations from the true value or long-term deviations. It's very difficult to know. But in simple words, it's market manipulation, and the boxes will do it. So, you can write many models, and all of them you will see the learning algorithm spotting a signal and then trying to rig it. If you think that when volatility is high, the spreads widen, because that's what you would get in sort of in an efficient market, and because of inventory risk for the market makers and all this story. But the black box can try and do something that triggers something where volatility ramps up. And a market that's more volatile, only because it's more volatile, might not be as nice as a market which is less volatile, where the only reason why it became volatile is a black box trying to move prices up and down in an artificial way. Okay, volatility is welcome. Volatility pretty much shows that people are disagreeing on news, and some people want to buy, some want to sell. So volatility is healthy, right? Because it's just pretty much telling you that information is coming into the market, and people are disagreeing, and people are buying, selling. But if artificially you blow it up just to take advantage of other traders, then that's not great. So that's another finding we have there. Another one which is quite important is signaling, which is within the umbrella of coordination. So initially we also spoke about machines don't talk to each other, but they can learn to send a signal to reveal their type, for example. So at the moment we have a study which we have not put out that is looking at some markets have very few players, okay? And if there's very few players, it's very easy. Imagine you and I are the big market makers in a particular asset, and we never talk to each other. But somehow our machines start communicating the following way. I send orders to the book to provide liquidity of huge volumes. And you, after a while, you work out that that guy out there that is always trying to, putting limit orders of 100,000, 200,000, 300,000 euros, whether, as much as that, it's me. And you do the same. So in the end, you and I enter into an agreement never to trade with each other, but just snipe all the inadvertent traders who think, this is a healthy market and there's competition because see a lot of stuff going on. But in fact, you and I never trade against each other, but we just wait for other people to come in and then we snipe their orders, especially their retail orders. So that's, that's something that we have evidence that it's happening. We're just writing the paper. We have also seen, machines that always use the, the same 2 digits to any volume they send into the book. They always end up in the same 2 digits. You have to question yourself, why would a machine do that? A machine has no preference for, if you ask me if I have a favorite number, 7 always comes to mind. A machine has no preferences over what is a nice number, whether a prime number is nice or not. But imagine a machine that always ends up sending an order where the 2 last digits is a prime number. Yeah. Then you need to question yourself, okay, what's going on here? Are they capable of doing this stuff? And they do, and they are doing it. So to me, it's no surprise. Now, how rampant this is not a question for me, but for the regulator and for the exchanges to figure out, how do we have a healthy market? An important thing, again, so I focus on the negative, the unintended consequences, which are not great. An interesting question, again, is what makes these outcomes more likely? Because, I could, as an academic, you focus on something that is new, different, exciting, but what excites me might be such a sort of rare occurrence that no one cares about. So are these freak accidents that we see? What are the things that would drive the market or these black boxes to coordinating into actions which are not competitive? Well, there's a number of things. So one of the most important things is the number of players in the market plays a big role. The fewer the players, if you have very few players active in the market, the chances of the boxes colluding or coordinating into outcomes which are not competitive are much, much higher. So one could say, right, one solution is to have, incentivized competition. But we've always known that. So this is not a new thing I'm saying. If anything, you would like a market that is healthy with a large number of competitors, but, they need to do business and you need to attract them. So it's kind of difficult. You can't really tamper with that stuff.
And I guess, but also at the same time, what we are also saying is the fact that they're black boxes still means it needs to be a competitive market. The fact that they're black boxes doesn't somehow mean that the rules of competition no longer apply. It still, in this case, applies. You need to have as many as possible to make it perfectly competitive.
You would like as many as possible.
Yeah,
exactly. And so that is a question you could ask yourself at any time in history. Do you have enough people here competing, right? So here we have exactly the same problem, but we prove it mathematically that, when the number of players shrinks, it is more likely that you have these collusive outcomes or super competitive outcomes. Super competitive here means that it's not sustained by competition, the outcome, right? You get to an equilibrium, which, competition would take you to something, if its prices are much lower price. So that's one thing. Now, another one, which is, once you think about it, you say, well, that's obvious. So let's think a little bit about how these black boxes are trained. Okay, so we've spoken generally about a black box. It's a set of rules with an objective and rules to update rules and to explore. Fine, we like all of that stuff. And again, that is great for the market. Now, imagine you're a trader in company X and I'm a trader in company Y. You're training your algos to, let's say, to buy and sell assets or to provide liquidity in the stock. I'm doing the same. You're going to use historical data to test it, right? And we're going to do many tests and many simulations. That's what I'm going to do in my company. You're going to do the same. You're going to go around. And one thing we show, which is quite obvious, is that these learning algos. So I'm going to put when I train mine, and I'm going to make it sort of fight against another guy there that I cook up myself, and he'll do the same. So somehow I include competition in my back testing to see how I'm going to react. The one thing that emerges very quickly is that there are different equilibria. Okay, so when I'm testing, I may know it or I may not know it. So let's imagine that I don't even know that different equilibria can emerge, because it's very difficult. There's a lot of noise and so on. But I'm going to test my black box under different initial conditions. And that's where the crucial thing comes. When I told you there's a set of rules, these rules are mathematical equations that have parameters in them. I have to, out of thin air, plot some parameters, put them in there, or I can sort of sensibly pick some. But one thing I will do for sure, after I spend weeks or however long I spend testing my strategy, when I go and deploy them in real life, I'm going to kick off with those initial parameters that gave me the best performance in my back testing. That is a sensible thing to do. You're going to do the same, and you could be using a different algorithm from mine, but you'll do the same. And it so happens that that sort of pre-trade sort of attitude to train and pick up the best initial conditions will somehow make us start on a collusive path or a coordinated path to an equilibrium which is not competitive. Because after all, you're going to be in the search for what gives you the highest profit. Of course, the highest profit for you may be the highest profit for me as well, as if we had colluded. So if I was given a chance, hey, Bilal, how are you doing? What do you put in that black box? Well, I put 3.4, 9.7. And okay, you know what? I had similar ones because that range delivered very good outcomes for me. So the training and the initial conditions that you use to set these algos running may somehow pre-coordinate the strategies to be more likely to start on paths to equilibria which are non-competitive, with outcomes which are not competitive. And that's kind of, again, a very interesting point that needs more detail, but we provide the mathematical foundations to show, well, clearly you can see it here, that it may well be that you think that, well, instead of having two people competing here to provide liquidity in this book, if you had 5, it's going to make it more, less likely to observe collusion. But if these 5 guys have similar algorithms, okay, and they pre-train them with historical data, the 5 of us, although the chances seem unconditional, not knowing what sort of initial condition you'll be using, it will seem so unlikely that these guys coordinating to this really bad outcome for the market. But when we do our sort of homework at home, we will coordinate to aim for that one without knowing, because I don't really know what you're going to be doing. But we all have the same incentive because we're all trying to maximize profits in a similar way. So that's one important point that makes these sort of algorithms a little bit interesting for me mathematically, but also for society to.
I mean, does that also mean that if everyone's using similar methodologies of doing their back tests and using similar data sets, they'll end up more likely to end up at this point?
Well, that's a great question. So I was at the the FCA, the Financial Conduct Authority, talking about these things. And it's a difficult question, right? Our sort of knee-jerk reaction is yes. If everybody's using similar data sets, similar algos, the chances of this, what I just described, of happening, are much higher than otherwise. Also, when people ask me, well, what does it mean a similar algorithm? It's very difficult. You and I are going to pick the same thing. You can do A, B, C. Now, the one thing that our models we don't sort of engage the models with this particular question, but we have a framework to try to answer it, which is you and I might have different models, but the one crucial thing that would allow us to coordinate actions is if you have memory in your algorithms. So something as simple and silly, which is I can develop algos that only see the state of the book and they don't look at the past of what I've done. Okay, those are less likely to collude because they have no memory of your actions. But if you're using algos that have one-step memory, so you know what you did last time, you know what I did last time exposed, because you see my bid and you see my ask, and and with one-step memory, that increases the chances of collusion quite a lot, because I can punish you. You see, these algos, the moment that they know what happened in the past, one step ago or two steps ago, the chances of being able to develop strategies that punish you for because you deviated from what we're trying to coordinate into are much higher. So algos could be different, but if you have memory, we know that the chances of super competitive outcomes are much higher. Okay.
I mean, listening to all of this then, and you said you spoke to the FCA, I mean, what can regulators do then? I mean, obviously one thing would be increased competition, but then the other one is, do they need to be quants themselves to look under the hoods of everyone's algos? And
well, I wish I had an answer to that question. So I've been to a few regulators in Europe and in the US and here in London, and clearly I just want to construct a conversation. Again, I focus on sort of a subset of things that might not be great. Overall, I think AI and trading is good for the market. Yes, it's how do they monitor them? So a question that normally comes is, can we sort of have in these black boxes, there's no moral compass, but can we sort of put something in there? And that's a very difficult thing to do, right? After all, you want innovation to be there at the forefront. You don't want to have any of these algos in a straitjacket. If you want to allow, I said at the beginning, people started trading the algorithms in a way they knew how trading was good and efficient and delivered the profits. Then with more data, you allow yourself to explore patterns and connections between asset classes and prices and macro announcements and CEOs' speeches, which otherwise you will not be able to uncover. So you need to allow this black box to roam free. So the roaming free can take you to a very nice place or to a really bad place. I'm hoping that most of the time will take you to a nice place. But the regulators, well, being aware is important already. Being aware that they can communicate, that's an easy one to do, right? Because if you start just by looking at order data with trader ID, which regulators have or some have, it'll be clear to see if some of these algos inadvertently are fixed on sending a signal. I know that's already the case, so it wouldn't surprise me that this, hopefully there's very few of these around, so they can look at this. Yes, and they have to become a little bit more sophisticated. So one of my answers to the regulator, well, team up with academics who are happy to produce some of this research at no cost to you, and the academics then publish papers, and it's a win-win for society. But it's, I think they're trying to find a way in which they can at least monitor the markets and spot some of these unintended consequences. But it's not easy, because a lot of my arguments in our papers say this is the competitive outcome. I know it. How can you and I come and say this is the true price for IBM shares of RAM? It's just impossible, right? So the level of difficulty is phenomenal. Then regulators and financial conduct authorities are used to also suing people for collusion, but there's clear communication. Now, how do you do this? These black boxes are not trained to collude. At no point are they endowed with actions that try to rip someone off or rig a signal. And then the black boxes end up coordinating actions. Now, the question the regulators do ask is, well, who is responsible for this? So who is to blame? The guy who wrote the code, the company, and so on. And I think accountability will be an important thing as to, well, who is accountable when an algo runs wild? And we haven't really spoken about macro systemic risks of these. My papers don't specialize in that, so I don't like talking about it, because I don't really have hard evidence of papers to support my what I say. But again, it prompts the question for the regulator: can these machines trigger some sort of actions that will send the market into a flash crash again? But these are the questions that you have been asking yourselves the last 50 years, right?
Yeah. No, that's great. I mean, we can carry on talking, but we'll end up going down too many rabbit holes. So I did want to kind of end our conversation with just a few more sort of lower level personal questions. One is obviously you work a lot with students, and many of our listeners are students. Many will be graduating this year from university and entering the real world. Well, not that academia is not the real world, I should add, given who I'm speaking to. But what advice would you give youngsters as they're sort of entering kind of their sort of grown-up phase of their lives?
Okay, well, yeah, the world today is so different from the one I grew up in, right? I see phones and all of this stuff. I see it, my daughters, I look to the screen. So I don't know if my advice is, not modern enough. But the one thing I normally do say to my students is, love with a passion what you do, right? And just try and find a job that, will pick up on some of that passion. Otherwise, you'll never be happy. And, rather than, so normally, that's what I say. I had a very bright student when I was working in Madrid many years ago, kind of asked me, I don't know how he put the question to me, but he put it like this: well, man, if you already know you're not going to get a Nobel Prize, or there's so many people much better than you, why do you keep on doing this? And I said, well, man, if you're not Messi, then you don't want to play football. If you're not Van Gogh, you don't want to paint. I don't care. I want to play football. I want to paint. So I love what I do. And, that alone is all I need to carry on. And I think, most of the time my advice is look for something that's going to entertain you. I have many friends. So, and something I tell my students all the time. So when, I studied in all these places and met a lot of very bright people, many of them are very successful people in the city and in Wall Street. And we have conversations along these lines, and I love them because I'm like, oh, hey, how are you doing? Well, yeah. And then, so, but man, what is your plan? Well, I want to retire by the time I'm 50. Or by the time I'm 55, I want to be, financially independent. I'm doing so well. That's my goal. I said, well, that's great. But so what are you going to do? You retire with all this money? Well, maybe I'm going to take it easy. I perhaps, I say, you're not going to get bored. Oh, I'll read, I'll write, I'll perhaps do some classes in a business school. And I said, all of that I already do, and I have been doing it for the last 20 years, right? Only that I earn a salary, and I do it every day. So academia is a path not for everybody, but the industry or wherever you go is something that, so long as you love what you do, the rest of it, I think
it's a great way of thinking about it. What are you going to do when you retire? Just imagine retirement. It's like we all want to become students again.
Exactly. Yeah, exactly.
Now, the other question I wanted to ask, and I see you have lots of books behind you, are, I mean, what are some of the books that have influenced you over your career, or perhaps even some books recently you've come across that you think, you want to flag to our audience?
Well, yeah, at the beginning of my life, I was more interested in literature, and like anybody, it's like a cliche, but reading things like Lord of the Rings was phenomenal for me. So I read them all in Spanish, and then I read them all in English many times. I love those. I love literature that can sort of transport you elsewhere, and you are elsewhere for a long time. Academically, I have been influenced by math books, econ books, essays. There's an essay that I thought it was Hayek, the famous Hayek, wrote this paper in the 30s about prices and information. I was highly impressed by that, and I've reread it over the years, and there was not one equation in that paper, and now you look at the papers, and if you know a lot of mathematics, most of the time you are kind of lost. But more recently, I spend my days discussing with my students on the boards, discussing with my students over coffee, sometimes over pints, and drafting papers, which is a very laborious thing to do. So my time for reading has shrunk by, 10 times, 100 times. But I'm quite intrigued about how politics works. So this book by Rory Stewart, Politics on the Edge, I've tried to start reading it a couple of times. I find that, what I've read, I love it, but I'm more after seeing how different politicians are from us and how similar they also are to academics. So the similarities are really that, academics, we're in the pursuit of the truth, but there's a lot of stuff, moving your ideas, promoting your ideas, and, some people block other people and so on, which is kind of the ugly side of academia. But on the other hand, the serious academics, and I would say most of us we are in the pursuit of the truth. Anything we say has to be supported by facts, and it's kind of painful sometimes. Whereas politics, lying is rampant. And this book by Rory kind of gives you a nice insight into what the hell is going on, and really depicts how different we are. So I'm more interested in that human aspect when I read these days.
Yeah, I can hear you there. 'Cause I went to Cambridge, and obviously, like Oxford, they have the debating societies and stuff. And what's interesting is the debating societies are often the training ground for future politicians. And what they do, these debating societies, is they almost like randomly pick a side. Like, okay, I'm pro this, or am I anti this? I don't mind. Give me whichever position I need to do. And then they incredibly articulately support that view.
Yeah.
They can switch sides just as easily as well. And there is something,
which is a great skill, right? But it's like the black box. If it's used in the wrong direction, it could be very harmful. And that's unfortunately the case we're in, I would say.
Yeah. Now, final thing what's the best way for people to follow your work?
Well, all of our work is on the web pages. Unfortunately, it's not as accessible as I would like it to be. We're in the business of writing academic papers, and sometimes, if I pointed you to some of the papers that underpin all the arguments I just put out today, you would say, well, I can't see the connection, or it's not immediate. So those who want to read the papers, they're all on my web pages, and you can go to the pages of the Mathematical Institute or the Oxford Institute. A podcast like this, I agree to do it simply because I think I have now something to say, and I want to sort of say it in a way that people can understand. And I'm hoping that I did a reasonable job. But that's about it.
That's fine. And I'll include a link to the sites and everything. And for sure, I mean, this conversation has been really, really enlightening. And you didn't mention a formula or an equation throughout this whole conversation.
No.
So with that, I mean, thanks a lot. It's been fantastic speaking to you. And, good luck with your research agenda, and keep up the good work.
Well, thank you very much for the opportunity. I'll be happy to talk to you again, but it'll take many years before I have something exciting like this to talk about, I would have thought.
No, I'm sure that's not true. Thanks
for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.